put together some different PowerPoints that will sort of highlight different things as we progress through the journey together. So when I spoke to Jordan, he asked me to do my top 3. Unfortunately, it's not. I was really trying to find a way to condense it to 3, but I'll just start from a big picture, and then I'll keep it to the top 3 on this list. And if anybody has any more questions, we can sort of go through a little bit more and talk more about some of these other ones. So we'll start right here. And I saw Moody laughing. And the funny part with Moody is he dropped something, the yield curves. And what a lot of people don't get is, I'm going to start off with the base assumption that the top 3 indicators that I'm talking about today are going to be leading indicators for a all stock portfolio. So that's going to be the fundamental assumption that we're going with today, that everybody has a all stock portfolio, because if you have different compositions of your portfolio, that's going to impact the different decisions that you make regarding your portfolio. But for the sake of today's discussion, we're going to assume that everybody has an all stock portfolio. And I really hope you watched Moody's video, because what happens in the yield market significantly influences what happens in the equity market. And if you want to know why, I'll go ahead and say why. The reason is the yield curve that we most of the time look at is the US Treasury yield curve. And why does that matter so much? That matters because you can invest in any part of the yield curve virtually risk-free, right? And so that is the fundamental basis of all investing, risk-free, right? Why would you buy anything other than a treasury if you're not going to get paid more? Treasury, risk-free, give the government your money, get 3% for 10 years and walk away. So that's why it's so important when we're looking at the yield curve, because if you can't generate a return that's greater than the US Treasury, just put your money in treasuries. The government's not going to go away. The US government, strongest economy in the world so far, have not defaulted ever, AAA rated credit. And so that's why that's top on the list. How do we use that, right? So yield curve. So I'll go to, this is, by the way, this is not Moody's video, but this is what I usually use as sort of a snapshot to get me to what I need. It's real quick. Everybody can just jump in on the bonds and rates section of the Wall Street Journal website, and it's right there, the yield curve. And so if you hadn't watched Moody's video, I'll give you a quick overview. So what you see here are the prices of each one of these. See, so the not the prices, but the change in price here for each one of these tenors. That's what they call it. The word is tenor, is TEN. And so the tenor here is the 30-year bond. And so, right here, these are coupons. All that is if you bought this 2-year note right now, today, you would get 3% interest every 6 months for 2 years. That's what that means. This here is the price change from yesterday's price. This is the yield to maturity. We'll get to that at a later. Okay, perfect. My apologies. So start over, 5 seconds. Wall Street, bonds and rates. WallStreetJournal.com, market data, bonds and rates. It's a quick snapshot. right? 30-year bond, all of these are tenors. So OR, coupon rates, the rate that you would get when you buy the bond, you get that every 6 months. This is the price change. Red symbolizes the 2-year note price went down from yesterday. This is the yield, which, as you can see, went up. So the way that works is go down, interest rates go up. So when people are buying bonds, the interest rate goes up. It's just math. It's nothing special. It's 100% math. That's why every yield curve, because you buy the bond, it's risk-free, and you know what's going to happen if interest rates go up or down without even having to think about it. So today what we can see is all the rates across the yield curve went up because people were selling bonds. And usually what happens when people do that is called risk on, right? So, not to get into too much beyond the yield curve, but when people are buying bonds, yields go down. When people are selling bonds, yields go up, and people are usually buying stocks. And so they rotate back and forth, and so risk on sort of sentiment. And if we look at the yield curve here, what this represents, and this is why I was saying, people focus on the yield curve quite a bit. I'm gonna drop this back at the 10-year, right? So the yield curve here on the medium to long term is basically flat. And so what that means is if you have a long-term portfolio, one of the positioning things that you need to start considering is, do I need to start shifting holdings into more defensive names that have dividends? And again, you want your dividend to be close to or above what the treasury yield is, because otherwise it doesn't matter. You should just go buy treasuries. Now, the other part that you want to consider is, if you're going to hold the stock for 5 years and the yield is 3.2 and the dividend, say, is 1 or 2%, so it's obviously lower than this. Well, what growth rate are you expecting to get from that stock? And so when you compare the growth rate and the dividend, then it might make sense to continue with that stock. So that's how you want to start thinking about positioning relative to what you see in the yield curve. Because again, the benchmark, when you think about discounting your cash flows for your stock portfolio, when rates start going up, the reason why stocks went down is a real math problem that's straightforward. The interest rates that are used in the dividend discount models and valuation models are based on either the 5-year or 10-year note. And so if those rates go up, which if we look at a year ago to now, just look at that. I mean, it's real, if you just look at that, like just everybody for a second, just look at that. So 0.78 last year, and then now we're at 3. That explains a 20% drop in the S&P, just purely based on math. If you did nothing else, that's why the yield curve is so important. If you just looked at this to this, that gives you your 20% right there. So, just high level yield curve, and what you would want to do as you are looking at the portfolio. These are some other rates that I like, but I do like this website because it gives you, some comprehensive stuff from overall rates perspective. It's like consumer rates, if anybody has ever looked at these. But it's more for a little later discussion. But if you're interested, this has all the different rates that could potentially impact not only your portfolio, but your personal financial situation. Fed funds rate, the prime rate, money market yield, which is trash, 5-year CD yield, 30-year mortgage, 15-year mortgage, jumbos, ARMs, and new car loans. So that is the yield curve, and it is wildly important. And so can you guys see this now? What are you guys looking at now?
Got you.
Okay, perfect. So it says leading indicators. Okay,
Yep.
awesome. Hoping to show the first time. So my apologies for showing that other worksheet. So the next one is the 10-year note minus the 2-year note as an indicator. And so let's see, 10 minus 2s, that's the name, right? So if we're looking at this, well, why is this important? Well, it's related to what we were just talking about the yield curve. The yield curve with rates, this is an indicator of inversion or not. And so before we move on, I just want to highlight the yield curve, its importance. In a bull market, usually it's upward sloping like this because longer rates will be higher and shorter rates will be lower. That signals that at some point in the future, there's an expectation that the Fed will increase interest rates to slow the economy down. So that's all that means when the yield curve is inverted. If it's the other way, then that means people are expecting the Fed to lower rates in the future to stimulate the economy. So we're close to flat, and there might be a potential, depending on how the economy does, which these are lagging indicators down here, depending on the economic releases later on, the Fed may say, okay, well, we're going to keep raising rates, and then we get into a recession. Well, then let's say a year from now, 2 years from now, they're going to have to lower rates. And so that's going to push up over the next 6 to 12 months, the front end of the curve. And so we'll go back here. That's going to push this end up. So this is going to go here, going to go further higher. And then these rates are going to go down. And all that is saying is that 10 years from now, not 10 years, 1 to 2 years from now, if this is lower and these are higher, then there's an expectation of inflation. I mean, not inflation, recession. And so how would you position your portfolio? Again, like I said, defensive stocks, stocks with solid dividends, stocks with increasing dividends. Also understand that right now we're right in the middle, which is why it's kind of flat. So if you do invest in bonds right now as a hedge, you want to stay on the 2-year or less until we get more certainty from the Fed. And then you can start going out further on the yield curve, say 5, 10, because if we think, let's say next year, 2 years from now, the rates are going to go down, well, if you have a 10-year note, but you obviously don't want to do it now, but if you, once the Fed finishes with their rate increases and you buy, say, a 10-year note at the end of the year, well, that 10-year note is going to decrease 2 years from now. And then your portfolio is going to go up because, again, when you have interest rates go down, bond prices go up. So that looking at the yield curve and what you would want to do in a bear to flat market. Signals. So where are we with signals, right? This is a big signal. I know you probably heard about it, 2 minus 10s. Well, what is that? Another indicator. So we just kind of, but what we didn't look at was the actual rate itself. So let's see, let's try and get it up here. All right. My apologies on the slow computer here. Here we go. So 10 minus 2. What does that mean? So we were just talking about the yield curve right over here and its impact on a portfolio. Now, how do you know if it's starting to invert, right? Well, one of the ways that you could tell if the curve is starting to invert is that you can look at the 2s minus 10s, and that is the 10-year note rate minus the 2-year note rate. And that is the 10-year on the curve at, let's say, 3.084, right? Minus 3.115. Just quick math in your head. This rate is less than this rate. So guess what? It's negative, right? So what does that tells us? That the yield curve is starting to invert. And so we absolutely, I mean, we kind of look at it because it is flat. Or when we look at the 2s minus 10s, or 10 minus 2s, then we can 100% tell that there's some negativity going on over there, right? And so let's look at 2s minus 10s as an indicator for a recession. So whenever 2s minus 10s, and this is on the Fed, St. Louis Fed, and so here, 2s minus 10s, barely positive in 1990. Then we had a recession. Then it went up. I know you all have probably heard this before, but it happens as a contract. It's done that several times this year, but it keeps doing it. And as that negative spread widens, more likely we are going to have, the more the likelihood increases that we'll have a recession. And so here, 2s, 10s, negative, followed by the 2000 dot-com bubble bursting, and then 9/11, which is a whole different thing, but there was a recession nonetheless. Again, 2s minus 10s. Now, the thing to keep in mind is if we look at this is 2006, right? And then the recession hit in 2000, it started in 2007. And for all intents and purposes, bottomed out in 2008, into 2008 or so to 2009. But I wanted to highlight that it is such a big leading indicator that it usually takes about a year for it to materialize. So we look here, when it's deeply negative or it first becomes negative, then the recession doesn't happen until a year later. But we are right here. And so that's kind of where we want to start looking, right? So July, negative 0.03. So if we're looking at that based on what we just talked about with the yield curve and the amount of time or proximity to a recession, well, what does that mean? We could say, well, within the next year, it's more than likely that we're going to have a recession. It doesn't tell us the magnitude of recession, but it does tell us that increased likelihood that we will have one. And again, when we're positioning the portfolios, we want to go back to, again, those defensive names and names that have strong cash flows, positive cash flows, first of all. And personally, and I'm a contrarian, so usually what I like to do is, as everything's getting crushed, I'm buying. That's just me. I always tell my wife, I'm like, look, let's have some cash ready. So when the people are like just dumping everything, I'm buying. Like, you just sell everything. You selling, like, I don't know, let's say Roblox, right? Well, Roblox may get acquired by somebody at some point. Who knows? Well, they make solid products. They have okay cash flow, but their stock is getting punished. So if I could buy Roblox for like, I don't know, whatever, I hadn't even looked, but let's say, for example, it went from $30 and now it's $2. Well, why would I not buy that? And even if it goes to 10 next year, I made $8. So, it's sort of things like that, because people just throw the baby out with the bathwater once these things start happening. And so, that brings me to my next sort of situation. So it's almost counterintuitive, but we're talking about an all stock portfolio. But guess what's the leading indicator? Stocks. But guess what kind of stocks though? Small cap stocks. So usually what happens is small cap stocks, in a bull market, they're leading the uptrend. In a bear market, they're leading the downtrend, right? So like the Russell started getting punished way early, way before like the S&P. And so when you start seeing that trend down, I mean, I know it's more fundamental, like high level macro, but the fundamentals under the hood is that small cap stocks have less access to capital. They have less networks, less moat. They have some advantages compared to large cap companies that oftentimes, both on the revenue side and a margin side, drive down the small cap index way before the S&P or a Dow Jones index. In fact, if you look here, a coincident indicator is the S&P, and then finally, which I didn't put on here, but it would be the Dow Jones indicator. And so by the time the Dow Jones started going down, then we're already about to be bottom if the bottom hadn't already hit. Like if you use the Dow as a indicator, then you've lost probably, I'll say right now, we're down 20 on the S&P. You'd be down like 50% by the time you're like, oh, maybe I should start selling. No. Please don't. Please look here, and definitely at the Russell. And that'll be a good indicator for you. Then M2. This is my favorite. And so the reason why I say this is my favorite, when the Fed dropped the rates, right? I was like, okay, well, kind of know what's going to happen, right? Basically, when the Fed drops the rates, what they're trying to do is they're trying to stimulate economic activity. When you can get money for free, what do? You're like, oh, I can go buy a car, I can go buy a house. That's what everybody did in mass. It's like we don't even realize the psychology of money. Just think about it. Like Jordan, like these guys know it like the back of their hands, but in the grand scheme of things, it's the psychology of money. And so money supply, one way to increase that is you drop the rates, right? And then that, in essence, makes money so cheap that it just floods the system. Well, how does it flood the system? Well, the Fed, right? The Fed buys bonds, and they're putting money into banks. They do a number of things via FOMC operations, which stands for Fed Open Market Committee operations. But anyway, long story short is you can buy a car for say 2%. You can buy a home, wow, for 2%. That's what people were doing. You were buying like homes for 2%. But when the money supply increases, that increases inflation. So at that moment in 2020, this is 2 years ago now, but I knew it was going to happen. I told my wife, I said, look, it's going to be bad. It's going to be bad. And she was like, I believe you. I believe you. And it was. And so this chart is going to be bananas when you see it, because you're going to be like, oh, like, I just want you to just look. Like, just look at that right there. Like, if you just looked at that, like, if you're right here and you looked at this, you're like, oh my goodness, everything is going to explode. And so there's no reason have been able to see that, okay, housing prices are going to explode. And guess what they did? They started to explode because there's so much money in the system. It's cheap and people can get it. People got the stimulus checks. They got so part of this is the Fed stimulus, but the other part is government as well. And so I'll just drop this back a little bit. And so I did this just so that everybody can see the steepness of this curve, right? So then if we look and we take it just from 2010 to 2020. Over that 10-year period, we went from 8 trillion to 16, right? That's not bad, right? Over a 10-year period. But guess what we did in a 2-year period? We went from 16 to 22. We went up 8 million, excuse me, not 8, 6 trillion in 2 years. 6 trillion in 2 years compared to 8 trillion in 10 years. Bananas. So of course that money has to come out of the system. And so as we start to look at inflation and the impact and all that, if we zoom in a little bit more on M2, we can see this started to peak. And so one of the things I learned from you guys is you're experts with technical analysis, and all of this, really at the end of the day, you're looking at charts, and you can see just from a chart perspective, you can see that this is starting to peak. Well, what does that mean? Well, when M2 starts to come down, just like prices jumped off and M2 was going up, it's the exact opposite direction. And so how does that impact your portfolio? Well, similar situation. If you are long before the money supply starts to increase, then you can keep your portfolio as is. You can flip over to those high flying, high growth stocks because they're getting VC money, right? That's what happened. So like, think of Airbnb, they were funded by a VC company. Think of all these different companies that were funded by and with VC money. When M2 starts to go up at a higher rate, that means that some of those IPOs, those SPACs, and we've all seen it, Kat, she's a reflection of this M2 right here. Everybody had money and everybody's growing. But of course, when M2 and the money supply starts to come off and you start seeing that peak, that's when, again, broken record at this point, but get the idea that these leading indicators will point you in the right direction and give you sort of insight as to how you should start positioning your equity portfolio. This next one, this is also a goodie. Durable goods orders. Now, durable goods orders, what are they and why do they matter? That is, what are companies ordering? Are they ordering new equipment? Are they doing, big purchases? So this isn't consumers, this is large companies and what they're buying. And so the reason this is important is if they stop buying, then they don't feel like it's a good investable market. They don't feel like as a company that they can grow their to make new capital. So, for example, if we look at Cleveland Cliffs, right, they're a steel manufacturer. Well, if they think the economy is cooling off, then they would not invest any new capital in any steel mills or plants. They're small, small to medium-sized company. So just think about companies like that. You could even think about a company like Deere or some of the other industrials. If they stop investing, I know that's what people sell off at first. So people sell off cyclicals, they sell off banks, they sell off industrials, they sell off commodity type companies when you're expecting a downturn because of this. Goods start to go down. So companies stop ordering stuff. So then these companies, these cyclical companies and industrials, their stock prices tend to go down because the stuff that they're making, these other companies are wanting to buy less of. If you're manufacturing a new building, you're a concrete company or you're, in real estate, well, you don't need to order anything from Deere or anybody else, because you don't need them to clear land for you. You don't need the land developed, so you're not going to buy stuff. So that's what this indicates here. So when you're looking at those things, it's very important to understand where you are in the cycle. And so let's take a look at that from a portfolio management perspective. So that's not the one. Okay, there we go. Yep. So durable goods orders. So one of the stocks I like, Caterpillar, Honeywell, some of the industrials, Raytheon. Well, doesn't look like they're stopping. So, and we just had a hot number from the non-farm payrolls, which I'll get to as a sort of coincident indicator. But hey, if I have a long stock portfolio, I'm like, okay, well, it's been doom and gloom, and everything kind of went down, but you got to ask yourself, well, why? Well, let me go back. What did we learn today so far? Well, we learned that so far, the first 6 months, prices in my long stock portfolio primarily went down because of shifts in the yield curve, and that's it. To a certain extent, the 2s, 10s, but that's more of the market and a fear at this point, in my opinion, of a potential recession. And so we're not all the way there, but the stock market needed to reprice because the economy was growing. And so when I see the stock market drop, I'm like, well, okay, well, I kind of knew that was going to happen. I positioned my portfolio accordingly. I traded into cash. And so now I'm ready to start buying some of these things that I know will keep me defensive, but also start scaling into some of the more growth areas that will allow me to slingshot out of the economy, out of the downturn once it's over. And so these got punished. Again, these are leading indicator. And so if small caps get punished, then you start buying like later on this year, perhaps, because they will lead us out of the recession 2 years from now, like $2, and then it goes up to 50 or 100, then you're definitely winning. And so if we look at the manufacturers, durable goods, look at that one more time. That's on an uptrend. Still, we haven't seen any peaking yet. And so I'll zoom in on that for a second. And we can look a little bit more to see if we start seeing. Right now, durable goods orders, they're higher than they were last month. So from an economic perspective, we still are not seeing anything that makes us want to go 100%. It's repositioning. But durable goods, people are still buying stuff. People are still investing. Companies, are still investing. And this one, I don't even have to go into it, but you guys know, right? This is a hot button topic. Mortgage rates, the highest they've been in the last 2 years, but not the highest they've been ever. People just got really used to 2% mortgage rates. And so housing prices were significantly elevated and need to come down anyway. So new housing permits, that's another leading indicator. Housing makes up a significant portion of the CPI, also the GDP, and that is why that is a leading indicator. Get back to this one. Okay, so where we are with that, everybody kind of knows where we are with that. And as you can see, for each recession is on the way down, but we are still early. By the time we hit the recession, so let's look at the peak and housing starts, right? That was 2005, and then the recession was 2 years later. So here, 1980, 81, or give or take, here, 72, 73, 1990. That one was a little short. That was real quick. So have enough information, we can kind of adjust. So what do we know? We know that this is the peak, December 2021 in housing. So it is 2022. And based on what we just looked at, we could say 2023. So probably around this time or late 2023, we would be looking at recessionary dynamics. So based on what we looked at and the data that's come in, we know that we have structured our portfolios appropriately. A potential recession within the next 6 to 12 months. Using these indicators here, we started to shift in late November, December into probably around the January, March timeframe for 2022 in an all stock portfolio. And then we can sort of get to some of these other ones that sort of corroborate what we've done. But these are the big ones. These will help you keep yourself from losing 50%. And you're like, oh yeah, I'm not gonna have a recession till next year or this, then the third. And then next year your portfolio is down like 50%. Like, oh, you're looking at your full, But these things will empower you, even if you don't fully understand it. You can just look at them and you're like, okay, well, Dave said this is upward sloping, or maybe I'm okay. Or he said this is kind of flat. Maybe I need to. Maybe I'm about to lose some money here. Tens versus twos, they're negative. Maybe I should start positioning differently. Small caps, where's the Russell? I thought I brought a chart up for the Russell. If I did not, I will do that. But does anyone have any questions so far? How would you structure your portfolio? Oh, here we go. So can you guys see the Russell? Awesome. All right, so I have my stock portfolio, right? And we just talked about this. So when Jordan and I were talking about this, so this was, you look at the date, that is November 2021, right? You got your all stock portfolio. The Russell starts to peak. Everybody has some technicals going on. This here is a simple 200-day moving average and a 50-day moving average, right? So if I'm in an all-stock portfolio and I'm looking at this, the Russell makes new highs and boom, I'm like, oh, okay. So now I need to start doing some stuff. Now I need to start looking. And I sustained a little bit of a loss here. Nobody's perfect. These are tools to help you start to reassess where your portfolio is going. So if we look here, this is in January, everybody's still feeling real good. We know the Fed's probably going to start increasing rates, but I still feel really pretty good about myself and my portfolio. But then here, this death cross here, and the Russell goes down. You're like, oh my God! So maybe I should really start looking at these other things. And then you're like, oh, let me pull up this quick cheat sheet that Dave had, right? Let me look at my leading indicators and see where these things are. Let me see if we're starting to get flat. See if the twos, tens is negative. And oh, I just looked at the Russell. Let me see if the money supply is getting flat or coming off. Then let me look at durable goods. Let me see if these companies are still buying things. If they're still buying things, I'm okay. If they're starting to decrease, then maybe I need to start switching out of some of these high flying stocks. I mean, like 100% get out. Like, some of these aren't like, oh, maybe I'll like start selling a little bit now. Like, no, like 100% out. Um, so then, if you this is when you start selling, start selling. Um, and then when you start seeing the S&P capitulate, I mean, we all witnessed it, then you know that it's time to not necessarily get out, but start switching. Good job with some of those sector rotations in some of the information he's put out. And it's very helpful because that's what people start doing. The other thing that you is at the end of every quarter, hedge funds and institutions, they rebalance their portfolio. So we had a lot going on during this time period. So as you can see, there's a peak here. The end of the year, people are selling off all of their losers, right? Because institutions and other funds, they want to have solid performance to report out to their clients. In March, it's the same thing. In June, it's the same thing. There was rebalancing. If you see this, if you just take a look, you'll see some of this, right? Even in the Russell, this is not a buy signal. We already talked about that. It's not a buy signal. This is rebalancing. So go back to March. This is not a buy signal. This is rebalancing. Rebalancing. You see this? In December, this is not a buy signal. This is rebalancing. Every 3 months, you can see it. So, non-farm payrolls, we just had that. Fed funds rate, we just had that. And obviously the S&P world, everybody kind of knows where that is. And then the lagging indicators, CPI, GDP, commercial and industrial loans, consumer debt, and then finally unemployment. And so I'm not going to go through all of these. I'm going to do I think these are more important at this point where we are in the cycle. And then I'll do a quick overview of these, and then ask any question, ask for any questions if anybody has questions. But payrolls. Obviously, if payrolls are increasing, that means companies still feel confident enough to hire people. And we just had a very 372,000 jobs, and that was pretty significant. And so if we look at that, let's see, that is here, right? So this is the source of that. This is Bureau of Economics, Bureau of Labor Statistics. And here we had 372,000 jobs in June, right? Unemployment is still at 3.2%. And so the consensus was 250,000. So from an economic strength perspective, that's what the Fed is looking at. They're like, okay, well, people are still getting hired. And so right now, their rate increases haven't had a significant impact on employment at all. Inflation is starting to peak a little bit, but it's not necessarily based on what they're doing because their impact hasn't cycled all the way through the system yet. So higher than expected. So, hey, guess what? Well, that's why we rallied. Now, we're not going to have a takeoff rally because we're still in a bear market. It made a big difference. Bull market, this continues to increase, generally speaking. It starts to decrease. And so when we start seeing that peak out, then we're already in a structural bear market. What I mean by that is from a S&P, because this is a coincident indicator, from a S&P perspective, the S&P is down 20%, well, it's about 18 now or something like that. But we keep going back and forth to that 20% mark. So the 20% decrease from the most recent high is a structural bear market. But right now, unemployment and durable goods is still screaming, we're okay. And so, I would say from a long perspective, you can now start to scale in to some of your higher growth names, but we already got defensive early this year toward late last year from a long-term portfolio perspective. So now as you're starting to look at these things, you're like, okay, do I need to find puts here, or doing things that would allow me to add some portfolio insurance? And so that's kind of also, tipping my head off one more time to Moody, who mentioned he had a post earlier this week around puts and long-term portfolio management strategy for that. So here, payrolls haven't started decreasing yet, but there are some elements that have started to get soft. And so we want to start positioning for a potential decline. And everybody's beloved Fed funds rate. Well, how does the Fed work? Well, if they think the economy is growing too fast, then they're going to increase rates, which they're doing now. They have an inflation mandate and they have an employment mandate. So right now they're working on the inflation part of the mandate because unemployment is above their target, or like right at their target. And so they don't have to worry about full employment because we're fully employed. And so when the Fed raises rates, that signals to you as an investor that the economy is humming along, but it will more than likely slow down at some point. They're hoping not to tip it into a recession, but right now you can safely invest in small increments. Defensive stocks, small positions, and growth stocks, and of course, protection using puts and other different strategies to protect your portfolio. Fed funds, where is that at? Okay, so another one of my favorites. We go to the Fed funds rate here. Now, if you look at this again, everybody on here is in full agreement with the understanding of technical analysis and how to use it, right? And so Avery looks out, I don't know, monthly, like long time frames, right? We look at the Fed funds rate back in 1981, it was 19%. Everybody, just think about what that means for 1 second. Short-term overnight rates at 19%. That means you could put your money in the bank at Bank of America and get 19% and take it out, do whatever you want, go make some more money, put it back in there and get 19%. That's not the rate that you get for holding it in the bank for a year, locking it down in a CD or buying a 10-year note. That is, hey, I can that is the most risk-free instrument ever. But when did that happen? In 1980, when CPI was at its highest. So let's take a look. Fed goes up, recession. Fed goes up, recession. Where are we at? Keep going. That's what people are afraid of. Once the Fed fund rate peaks out, then there's potential for recession, right? But the thing I like about this is, if you look at it from a long-term perspective, particularly from a technical analysis perspective, that trend has been downward. So what does that mean now for us in a I won't say hyper, but almost hyperinflation sort of environment? That means that right here, we're just starting what will be the reverse of this trend potentially if inflation doesn't cool off. So what does that mean from a treasury curve, what we were just looking at with the yield curve? That means interest rates are expected to go up as long as, even within a recession, as long as inflation is high. So if you have a portfolio with bonds in it, your bonds are going to go down. So bonds go down, as we talked about up here, when prices go, so interest rates go up when bond prices go down. Because the Fed is increasing interest rates, then your bond prices will go down. So that's just really something to consider as we think about that. We look at and we say, okay, well, where is CPI at? Well, CPI, this is just regular CPI, 8%, and we look at 6%. And so these are really, you know, key items that you really have to look at and things that impact your portfolio. Top things that impact your portfolio. I said I wasn't going to go too much into the leading indicators, but I mean the lagging indicators, but I had to address CPI because that is something that the Fed overnight rate is driven by that and unemployment. So, you know, if you don't look at anything else, you know, look at these. You know, these have an impact, and you hear a lot about, you know, obviously CPI, GDP, you know, industrial loans. Obviously, companies loans, they're confident in the economy. They're using the loans to finance growth, and thus and so consumers, you guys consumers, if you feel good about the economy, you go out and borrow, you know, even at these rates. When this starts to peak out, when you stop feeling comfortable about using your credit card and buying cars and, you know, all that kind of stuff, then you can really say, okay, well, now I need to start selling even more. And so long-term portfolios, a lot of people in the market, professional money managers, they're, you know, 5%, 10%, some people 20, 30% cash. Those positions are significant for professional money managers. And so those are some things as well that you want to consider when you're looking at your personal portfolio and how you are managing it. And so those are some key things that I really enjoy looking at and that I use on a regular basis to assess how to adjust my portfolio, what to do with it and when, and how to make sure that even though, you know, we're not perfect and nothing is a crystal ball, that I maximize my portfolio performance while I am limiting my downside risk. So all that means is I'm using these top 6, you know, as Jordan was trying to, you know, get me to stick to 3. I'm using these top 3 to say, look, I know I'm going to lose money. I'm trying not to lose 20% with the S&P. I'm trying, you know, only lose, I don't know, 5%, or maybe I can make money if I do it early enough and pay attention to these things and make the adjustments before they happen. So I know what to look at, what the name is, what to do when, and where to get the information from. And which one of these things is sort of most important in terms of the hierarchy in which I need to look at it. So yeah, so I guess if anybody has any questions, definitely let me know. Let me know your thoughts on the information and how I like to use it. I kind of mentioned it a little bit. Right now, I'll just tell you, generally speaking, in equities, my bond position is probably about 5%, just because, so my bond position is about 5%, and it is in short duration, so 1 year to 2 years. And then from a cash perspective, because I don't want my cash to just sit and do anything, I have a lot of my cash in 3-month, 1 and 3 month notes, bills. And so we go back to here. So what does that mean, right? So if I have 1 month bills, then that means it's like cash and cash equivalents, right? So it's not sitting in the bank and they just roll over. every month when they increase interest rates. So when the Fed increases interest rates in the July meeting, let's say 75 basis points, this is going to go from 1.9 to 2.75, right? So the money's just sitting there. And if you roll it each month, you can just have your money making money risk-free while you decide what you want to invest in. And so that's sort of how my portfolio is structured right now, as these roll off. So I have 1 month, 3 month, and 6 month bills, and then these kind of roll each month as the Fed increases interest rates. So the short duration allows me, let's say in July 26, when they had that meeting, my 1 and 3 months are just going to roll over, but they're going to roll over at the new higher rate. And they're not going to be exposed to this long side. Let's say if I have like a 5 or 10-year note, but when that goes up to 4% and I had a 10-year note, it's going to crush my bond holding. So I don't want to do that, not right now, when I know for a fact, these are known knowns, right? Like, you know that the Fed is going to increase interest rates. It's not like you don't know, right? It would be different. We're not even talking about events that haven't happened yet. We know that the Fed is going to increase interest rates. They may do 50 basis points, they may do 75 basis points, but we know that this 10-year note rate is going to go up. So why would you want to purchase this when you know the price is going to go down? So that's why I'm here. I'm right here. Right. So from a leading indicator perspective, coincident indicators and lagging indicators, that my overview of what to look at, when to look at it, and how it impacts what you would do or want to do with your portfolio. Now, didn't go too much into the different instruments and tools, but there's tons of different tools that you could use to execute. And so be more than happy to talk about some of those, as well as, again, what to use when. I'm sorry, it's one more thing. And this is cool. And the only reason why I say that is because it's part of like the fear and greed. Like this is this index of consumer sentiment over the last 60 years. So take a look at that, guys. Where are we at? These kind of gray marks are like recession. And so by the time we get here, these things, we're close to or in a recession. But we are not right now, at least according to the National Bureau of Economic Statistics, who is the actual institution that declares whether or not we're in a recession. But if we just take a look at this and then we look at every time it's this low, we're in a recession. So if you just looked at that and said, hey, well, maybe we're already in one, you wouldn't be too far off base. Or you could say, well, maybe we had an exogenous event or a global crisis, and that's what has everybody like super scared and why we think we're here. So, I just wanted to bring this one up because I think it's kind of cool. It's almost every time it happens, we're in a recession, but you can look at that and we'll see once the GDP numbers come out later on this month, if Q2 we're actually in a recession. So we'll see, but in terms of sentiment, this is another indicator, and you probably already know everybody thinks the world is falling, the sky is falling, but this is when Michael Berry started buying. This is when BlackRock started buying. So if y'all get what I'm saying, there's a time to sell. And so these were like, hey, it's time to sell, it's time to sell, it's time to sell, blah, 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 By the time we get here and it's consumer sentiment and all that, that's not even on here, because by the time you get there, like, you know, some of the sophisticated funds, they're scooping up everything. By the time we get to the end of the year, the smart money will have bought all the losses that you sold. And so this is, this is something to keep in mind there. But yeah, I mean, what to sell, what instruments to use to accomplish some of these goals. If you have questions, or the indicators themselves, definitely let me know. And if you have any questions, any other questions tonight, I'm game. Oh. So this is my first time doing this, folks, so I do apologize in advance. It looks like there were some things blowing up in the chat, and I just like missed a lot of them. So I will try to go through as many as possible. So my apologies. So somebody asked about the I bond. Yes, I have a bunch of I bonds. You can do 10,000 per year. That's the limit. The reason they limit that is because of smart people that are on this platform that are like, hey, I've been watching what Dave was saying, and I'm selling out some of my equities. I'm going to go into bonds. They're paying 1-2% right now. If all of us on this platform got I bonds, then yeah, they run out of supply. So yeah, I bonds, excellent idea. I have a bunch of those. The thing with those is you cannot redeem them for 1 year. When you purchase the I bond, they have a 1 year minimum holding period. Then after that, you pay an interest penalty of 3 months. So if you redeem them in 1 year and 3 months, then you get an interest penalty. So it goes away after 5 years. So you buy the I bond, you wait 1 year to redeem it, and then after 5 years, you can redeem it without getting any penalty. They are tax deferred, meaning that the interest accrues without you paying tax on it for the life of the bond. You only pay tax on the interest when you cash the bond out. Let's see. Somebody says you're the GOAT for giving this much information out for free, Jordan. I think you saw that. Let's see. The indicators, are there indicators that will help understand the direction of the Forex market? Good question. I mean, some of these do impact the direction of the Forex market as it relates to the dollar. So I was gonna do some of that on here too, but I didn't want to get too complicated, and I hope I wasn't too complicated tonight. But DX, which is the dollar index, and gold impact Forex markets. Obviously, if the dollar index is going up, then that means rising relative to other currencies in the basket. Other currencies in the basket include the Swiss franc, the Swedish krona, the euro, the British pound, the Japanese yen. And so those all go down in the Canadian dollar. So the dollar's going up, all those currencies are going down most of the time. And so what makes the US currency go up? If the Fed is increasing interest rates, we talked about that, that usually reduces M1, which reduces the money supply, which makes the strength of the dollar increase. And so if the Fed is increasing interest rates, the dollar goes up. And so that's how you can use that to apply to the Forex market. Right now, Brexit, so one of the positions I have is I'm actually a long-term short of the dollar. And so I expect that to reverse itself. And so what I did was I have options on the euro. So call options on the euro as a hedge to my short dollar position. And so I actually think that once all this stuff settles out, that the dollar itself is going to come down, the euro is going to come up, and the gap between the dollar and the euro is going to collapse, and we're probably about 1.2 or 1.2 and a half at least on the euro USD rate. And so right now the dollar is super strong. People are going to quality, flight to safety, all that kind of thing. And so Brexit, not Brexit, but the euro, they have not increased their interest rate as fast as the Fed has. And so that's what has caused their currency to decrease relative to the dollar. But I think that trade is going to reverse. And so I am long-term short the dollar, but I am long via a call option on the euro USD pair as a hedge. What number does the yield curve have to be to indicate a recession or bear market? Good question. So the yield curve itself is not a number. It is a series of numbers. And so if we go back and we look at this page here, so the yield curve, and so I'll prepare a different chart for that. I have a chart I can kind of illustrates where I want to go with that, but there is the Fed funds rate. So if we look at this here, the Fed funds is targeting an inflation rate of 2%, right? So as the Fed gets closer to this 2% target, then this rate up here will be closer to 2%, and these rates will go up actually. So once we see the 1 month, 3 month, and 6 month consist of 2%, at the same time having a steepness in the yield curve, because this is basically flat, right? So if we see some steepness in the yield curve, then the Fed will stop, and we won't have, that's a sign of like growth. But if this keeps going and it goes significantly above 2, so I'll answer your. If this is above 2% for a significantly long period of time, then that means the short rates and the medium term rates and the long rates are all the same rate. So if we have a situation where you can get 3% or percent in 1 month, and you can get that same rate for 2 years, then we have a problem. If this 1 month rate and this 3 month rate goes above year rate, then we'll have a serious problem. I have a chart I'll pull up. This is a futures chart for crude oil, so it's a different. It is a different instrument, but the principle is the same. So, okay, so looking at this, if the curve goes this way, if the treasury curve goes this way, so that's downward sloping, right? That's called inverted. So if the curve becomes inverted, then we will have a recession for real. And more than likely, if it gets too inverted, a crisis, sort of like, the financial crisis. So, this is apologies for using a different instrument, but the theory is the same, meaning like, so Avery and I were talking earlier today, and this is the crude oil futures. And so the principle is the same. So right now, crude oil is $100 or so, but the futures curve is signaling that we'll be at probably about 80 by this time next year. And so that's inverted. This is normal. This was like, back in 2020, the curve is usually upward sloping, meaning that we expect that prices will generally go higher each year by about, you guessed it, 2% per year, because the Fed's target is 2%. So the goal of the Fed is to have everything in the US increase by 2% a year. That's it. And so that's why the curve, that's why it's normally sloping upward. But right now, crude oil is sloping downward, which is a leading indicator as well in the commodity market. And with the dollar being so strong, that's another reason why the expectation is for lower crude oil. So recession, if the yield curve inverts, that's what we'll have. And this chart here, if I can get to it, kind of goes through from a treasury. Let's see. So this shows like the difference of, so this is where we were last year, the beginning of this year. This is in May, and so as you can see, like rates just keep going up. But this is on the medium side, and it's like flat, right? And if that shifts and it goes the other direction, then yeah, we would definitely be in a recession, right? 100%. The Fed funds rate to people, they don't understand the Fed funds rate. Okay, so the Fed is the central bank. So my apologies for folks that don't understand what the Fed funds rate is. The Fed funds rate is the rate that the Fed charges for overnight deposits from each bank. So it is an interbank. This way, the deposits that Bank of America has on hand with the Fed, that Wells Fargo has on hand with the Fed, there's a rate that they get charged overnight, or not that they get charged, but that the Fed pays them when they borrow from each other. So that's what the Fed funds rate is, the overnight interbank rate. The bank rate that's charged when banks borrow from each other using their overnight deposits that are stored at the Fed. So if Bank of America, if they have $100 million in the bank, Wells Fargo has $200 million in the bank, Wells Fargo needs an extra 100, and Bank of America, they need an extra 50. And Bank of America says, okay, well, I don't need that 50. Bank of America will give 50 to Wells Fargo. So now Wells Fargo has 250 million in the bank, and the Fed funds rate is the rate that Bank of America gets from Wells Fargo for loaning that money overnight. And so it's like, if Jordan said, hey, I need 50 bucks and I got 50 bucks in extra cash, I give Jordan 50 bucks, I get the Fed funds rate, and then tomorrow night he gives it back, and that's it. So that's the Fed funds rate. Is there a chart that compares the recession period for S&P and QQQ on the same chart? There is one. I would have to look. I don't have that in my wheelhouse readily available. I think I have one somewhere. Millionaires created a recession. Yeah. Billionaires created in any condition. Yeah. Being that the market is largely sold off in the last several months, what would we look at to capitalize on the market rebound? That is a good question. And somebody was paying attention because they were like, hey, these leading indicators led everybody to sell, and then it's time to scoop up. So have we hit bottom? Also, no. So I think based on what we talked about in the durable goods and the payroll, we still have some more to go. And so defensive right now in terms of positioning, and scaling into some of the things that you were like, oh, well, the valuations are crazy, it's super expensive, I really want to buy such and such stock, but it's too high. Well, now you can start buying those, particularly in the tech sector. They're down like 80, 90% in some cases. So if it's some names that you feel like will still be alive, then yeah, I mean, what you don't want to do is, okay, well, I feel good about this stock, or everybody says this stock is great, and then you buy a stock that, you might have bought in 2000 that, didn't survive the dot-com crash. You don't want to do that. You want to look for companies with relatively high price to sales, but not too high, right? And then they won't have any E because they won't have any, so you can't say PE because they won't have any E in the earnings side, but you want to look to see if they do have positive cash flow in some sort, maybe not crushing it, but look at the cash flow statement and look to see if they have cash flow in general. To see, some of these companies that are growing their top line quite a bit. And one of the things to consider though, in this type of situation, growth rates are going to compress, margins are going to compress. And so no company, when I say this, I'm just telling you, if they say they do, they're probably lying. If GDP is 4 or 5%, you can only grow or outgrow GDP at like 20, 30% clip if the industry itself is growing and you're a new company. If you're a mature company, then you're not going to grow that fast. If you're in an industry that's consolidating, you're not going to grow that fast. Take MO, for example, or Altria, right? The industry itself is decreasing. They sell cigarettes, and even if the market share, the industry itself is decreasing. So from a growth perspective, if you're looking to slingshot some growth, that wouldn't be the company. That's one of those safer companies that's not bleeding. You can get them, you can get the dividend and hold it for a while. Now they're losing a little bit of market share on the e-cigs to Philip Morris, but if you wanted to do a combination of like that's a defensive type stock. They have like a 7% dividend. If you wanted to do something like that, you already know that people are gonna smoke in a recession. No matter if cigarettes went up to $20, people still gonna buy cigarettes. It's like not that sensitive, but the stock price might still go down a little bit, but it's not gonna tank. So you can get some dividend growth from that company. And then you could start to look at, like I said, some of those companies that were really growing, let's say maybe they cut their guidance down to say, instead of 40% this year, maybe they're only going to go 20 or 15%, but it's still double-digit growth. And then look at their cash flows to see if they have positive cash flow. Do I believe we have a recession with high job growth and low unemployment and high CPI? That is a great question. That's the one that everybody's trying to figure out. So what's my take on it? Yes, I think we can have a recession. So think about recession in the metric. So here's the thing, and this is why this is important and why understanding these indicators is so important, what they mean. So GDP, and we can, I'll drop a search in here real quick and we'll look at what GDP is. But GDP is output. So Y equals output in this formula. So the output is equal to consumer spending, net exports, government spending, and investment. See, that's the formula, right? So that's why durable goods are important. If businesses stop investing, then yeah, we could have a recession with growth. I mean, that's possible. They could stop investing in capital improvements, but depending on the type of recession it is, let's say it's a goods recession, right? Where we've already started to see that a little bit because people have spent all their money. Like, think about it. How many different computers or TVs or cars or whatever are you going to buy? These are one-time purchases. You did it during the COVID period. You're going to stop, right? But the services, they can still grow. They still have room to increase that job growth, right? So you are seeing in the tech sector some layoffs. You might see a little bit in the goods sector, some layoffs there later on this year, early next year, but you could still have GDP growth because consumption is still happening. People are still spending, they're just shifting it from goods to services. So the GDP itself can go down, right? And we still have high job growth, but just in the service sector. So then low unemployment, obviously that goes hand in hand with high job growth. Now, low unemployment, well, mathematically speaking, it's almost impossible to continue with a 3.6 unemployment rate and still have a decrease in GDP, right? But where do you see employment in GDP? It's not in here, right? So we measure a recession by a decrease in GDP. 2 consecutive quarters of a GDP decrease. Well, unemployment can go from, and this is what the Fed is thinking, unemployment can go from 3.6 to 4, right? And still be low relative to the last 20, 30 years. And so I'll pull up another chart with like the historical rate of unemployment. But yes, unemployment can still be low and we still have a recession. Then the next part of the question, high CPI. Now that's where things kind of get squishy and why the Fed is so laser focused on CPI. Because what tends to happen is, so we can still have GDP with CPI going up, because let's say, and my former manager used to say this at work all the time, you only have 2 things that generate revenue, right? We all like to talk about the drivers. I do it at work. What's growing our revenue? And what are the components driving revenue? Well, at the end of the day, you have 2 things. You have volume and you have price. Those are the only 2 things that drive revenue, is volume and price. That's it. That's it. So now, if you say, well, I have Sunkiss and I'm selling 50 Sunkiss at $10 a piece. Well, that's $500, right? So that's 50 units at $10 a piece, right? So that's volume and price. And then let's say maybe I'm selling phones at $100 a piece. So that's $1,000 plus $500 from my soda. But again, it goes back to volume and price. The only thing I'm doing is I'm accounting for 2 different products, but I'm still just with volume and so GDP can stay high as long as inflation is high. And so what will bring, because it's, same price level, right? So if you are paying now, instead of who would pay $10 for a soda, right? But here we go. So I sold 50 sodas for $10, right? But oh, guess what? Now inflation happened. So now I still sold 50 sodas, but this time I sold the 50 sodas for $20 a piece. I don't know who's buying my sodas for $20, but my point is, last I sold 50 units, I sold 50 units, but the difference is last month I charged $10 per unit. This month I charged $20 per unit. But guess what? My GDP went up by 50%. But what did I do? I did nothing different in terms of the quantity. I just increased the price. So that's where the high CPI part comes in. Now, the reverse is also true. So to answer your question, can we be in a recession with high job growth, low unemployment, and high CPI? Yes. And then somebody said that sounds like stagflation to me. Ding, 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 right? So yeah, so GDP is like right here, right? It went up, and then it just kind of stays there, right? Doesn't move. but then we keep having higher, because now you're not really selling more units. The prices are just going up. And then here, right, you're starting to see less and less government spending goes down. And then because the dollar is so high, which y'all seen that too. The dollar, I think the last time I looked, it was like 107, right? This is like ridiculous. It's like I don't know, 10, 20-year high or something like that. But anyway, so that reduces net exports. Well, why does that happen? That means the price that, not us, so we're actually, when the dollar goes up, what happens is US citizens pay less for the goods. But the goods that we are exporting, let's say if somebody's buying our goods from the UK, they have to pay more. And so that's why this part of GDP goes down. Let's see, where do you buy notes from, and are there any fees associated with it? I'm not sure if I understand the question on the notes. Baby boomers smoke cigs, new folks vape. Yep, where are the vape companies? Well, Jewel, they haven't passed that law yet, but even if they do, there's going to be a way around it. Those of us who hadn't got lung cancer, I'm on the cusp, and then diabetes. And yes, absolutely. Which brings me to the next point of defensive companies. Hey, guess what? Guess who else is making money? Hospitals. And as COVID loosens, those bed counts go up because people can get back. I mean, I know it's kind of savage, but I'm just telling it like it is. Hospital companies, they're going to make money. Drug companies, GlaxoSmithKline, Bristol Myers, they make money. Johnson & Johnson, these are drug companies. I'm not talking about like biopharma. I'm talking about people that are selling you these pharmaceuticals, Merck, those kind of companies that are selling these drugs to you for these, chronic illnesses and diseases that usually plague, unfortunately, disproportionately African-American communities. But yep, so drug companies, healthcare companies, solid companies usually have good dividends and all that stuff. So definitely something to consider when you're looking at portfolios. Then let's see, Google's what stocks dropped the most in a recession. That is funny. That is funny. Usually, and this is why it's so important to think about these things in the context of what we were looking at in terms of these indicators, right? So what you notice too is it's a lot of, so this is a consumer sort of situation. So D.R. Horton and Lennar and all those folks, their stocks dropped a while ago. Why? Because houses is one of the biggest purchases. Those tend to hit first. And so those stocks got hit, a while ago. Financials, they get hit. Why? Because, people are expected to borrow less, but it's wishy-washy with financials only because they also make money because they can charge more for loans. And there's a twinner part in which if rates go too high, then it reduces demand so much that people aren't going to borrow. But in that transition period, people are still going to borrow while banks are still raising rates. So their what's called net interest margin does like this. So what they do is they increase, and you've probably seen this, and this is why like mortgage rates like sort of had everybody like ridiculous, because that was the first thing that repriced. So mortgage rates went up, but guess what didn't go up until around now? Deposit accounts. So guess what you can get on your deposit account now in a lot of cases? You can get 1%, 1.5%, like SoFi. I think they do 1.25%, right? But mortgage rates have been about 5% since February, March. And so they've had almost 4 months of this high mortgage rates, low deposit rates. And that's how the banks make money from what's called the net interest margin. So they didn't reprice their deposit rates until recently. And even then, they're still much, much lower and mortgage rates, and they make money on the spread of loan rates. So cyclicals, industrials tend to go down. But what you'll see though is small caps and industrials starting to get bid up toward the latter part of the year, and the deeper that we get into the recession. The reason why is the smart money knows that those tend to snap back. And so while everybody's crying and throwing the baby out with the bathwater, and the industrials are taking a dump, the financials are taking a dump, the smart money is buying them voraciously. Toward the end of the year, let's say December, they hit bottom, and you bought, let's say, steel, you bought aluminum, you bought like Rio Tinto, some commodity stuff. You start buying, a lot of these value stocks. They've underperformed for years, but I'm specifically talking about like cyclicals and industrials, Dow Chemical, things of that nature, and then obviously, some of the energy stocks. So they get punished. You buy them toward the end of the year, early next year, while they're bottoming. And then when the economy starts to grow again, then you are way ahead of the curve, and everybody's trying to rotate into the cyclicals and industrials and all that when the economy starts to pick up again, but you're already in them. So it's just, it's hard to time it, but that's sort of what happens under the hood. And I think, some of the stuff that Moody's been putting out sort of highlights some of those shifts that happen under the hood. Sometimes it's in line with retail and institutional, but a lot of the institutional investors, they try to make the moves before. And so if something's going to pop, it's like, say for example, I know Zendesk, they had a failed acquisition. It didn't work out, but that signaled to me that they were looking to be acquired. And so what happens is, it doesn't always work. It's an arbitrage strategy, but it's buying a bunch of stock, or at least call options in a stock in which they're going to be acquired. And so what happened was Zendesk got a firm offer, and so they're going to get acquired at $77 per share. And then the stock popped 25% that day. And then it's just kind of hung there because that's the acquisition price. Well, if you were already in the stock, then you were able to capture that difference, and it's almost a risk-free sort of gain there. But the concept of looking at cyclical industrials to bottom out and buy them, small caps and the like, before the economy recovers. But most of the time, it's going to be when everybody is selling them. Defensives, they've been bid up. I mean, you can look at them, this week. Guess what happened? Guess what people were selling? They were selling consumer staples. They were selling healthcare. They were selling utilities. Why? Because the big money is like, oh, well, this wasn't as bad as I thought it was. Let me rush back into these industrials and cyclicals so I'm not left behind in case we keep growing and we don't have a severe recession. So, just some things to think about. Kia, straight from the website, Treasury website. Not sure what that meant. Kia, I think they're a good brand of car. I'm not sure that I would get a rate from the Treasury website specifically though. But Treasury does have their rates published on the website. And a lot of the sources I use are Wall Street Journal, Fred. They have almost every thing that you could think about. Oh, website where you could buy Treasury notes. Gotcha. Great question. That place is Treasury Direct. And so you just go there. You have to get a Treasury Direct account. You log in and blah, blah, blah. You can, buy out your heart's desire. They have treasury bills, notes, tips, treasury bonds, floating rate notes, series EE, I. H bonds are retired, so you cannot get H bonds. But you can get all these other types of bonds. Great question, about, because we were talking about yields. And so these are some instruments that I really like. And again, the reason why I like them is because it's absolutely free, risk-free money and a great place to park your money when you don't know what to do. Like that's the thing. It's like we're like right here in like the yield curve. I mean, we looked at it, it's almost literally flat. And so it's a lot of indecision in the marketplace as to what to do with your money. And so why just leave your money in the bank? Even if you had like a SoFi account with 1.25%, you can still do better without locking your money down in a CD. So like CD rates are still like, trash as well. Like I think, one of the places that has the highest rates I've seen so far for CD rates, so you can go to bankrate.com and look at the CD rates if you're looking for somewhere to park your money temporarily other than the treasury. But like banks, this bank here, they have like basic CD rates that are pretty decent. And I mean, I really like them, but again, it just all really depends on what you're trying to do. And so their 1 year rate here, and this is what I mean, right? You got to really like look at the rates and look at like what instrument you want to use for what, right? So we just looked at the 1 year treasury, right? And so let's take a look again. So we're looking at the CD rate, 2%. And then we look at that was for 1 year. And then we look at the 1 year treasury bill. Like, why would you do that? Why would you give a bank your money, put it in a CD to lock it down for 1 year where you could get a treasury bill and get almost a whole percent more? And so CD rates have not caught up yet to the treasury. And so historically speaking, once you see that start to flip, then that's when you're like, okay, well, now the incentive to actually lock my money down here as opposed to the treasury might be worthwhile. And now let's see, we go here, 3-month CD, and that is almost a whole percent less. Like that, like why would you do that? And let's see, actually, I'm not even gonna do that. I have another summary thing that I like to use that kind of outlines that a little better. And so let's see. So I kind of use this thing right here to through what makes the most sense. So I mean, it's just a quick summary, but if I'm looking at brokerages, like right now, E-Trade has an online savings account for 1.4%. M1 has 1.3. Ally, they just actually increased their rates to 1.5. So that's that. But if I'm looking at this for TII Bank, then their CD rates are the highest compared to the other banks. The reason why these are so small, like if you look at that, like why would you do that? At Wells Fargo, why would you put your money in a CD for 3 months at 0.01%? Like it's just, it's highway robbery. But remember, I was telling you, so like if you were to go to Wells Fargo and get a mortgage, they're gonna charge you, let's say you have perfect credit, you're gonna get 5.38% for a mortgage, perfect credit, right? Now, let's see, somebody said Discover Bank. Let's see, throw that in there. is Discover Bank for online savings, money market, regular savings, CD, oh, okay, online savings. So 1.0. So still, you know, you're looking at on a 1 month, and those rates just changed. I haven't updated that. So if we go back and we look at let's see, we look at that treasury again. Right. So we look at the 1 month, that's 1.49 on the treasury. I just have to key these in, but you get the idea, right? You can get a treasury for 1.49. Why would you put your money here? Here, here, here. So you could, in a sense, it right here, it comes down to liquidity preferences. This is held for 1 month. If you need the money within a month, then maybe it makes sense to put it in Discover Bank or one of these other banks. But if you know you're not going to need it for a certain amount of time, let's say you know you got $10,000 sitting somewhere, you know you're not going to need it for the next 9 months to a year, well, just park it in Treasury, or, you know, obviously a CD if you want to have a little bit more access to it. But, you know, the Treasuries is just fine. You can get additional interest on those with no risk. So I'm loading in CD rates for, okay, so I would have to look. So I usually don't go past 2 years for the CD. What was it, 12 months? So if we just look at this though, right? Like let's say if we just ignored, so I just dropped in some rates for Discover. The person said 1.9 for 12 months, 2.25 for 2 years. Well, I haven't even updated the 2-year note rate, but if we just look, you can get a 2-year note and, you know, over 2 years, grab an additional, you know, 92 basis points. And so that's kind of, you know, when you're looking at the cost benefit, you know, it's actually costing you 1% on your money. Let's say if you had $10,000, right? It costs you $92 to keep your money here as opposed to buying a 2-year note. And so, you know, if you want to give up $92, hey, that's great. I could use the $92 for, I don't know, 4 to 5 Five Guys trips for me and my wife for doing nothing but keeping my money in a 2-year note and just getting the money. And so, you know, again, this goes down to liquidity preferences. And what I mean by that is it's a little bit more friction go to, let's see where we at. It's slightly go through the process of setting up a Treasury Direct account and buying the Treasury notes. But once everything is set up, it's pretty straightforward and and they roll off. You get the 2-year note, you get the interest. If you want to do something with the money, you can do whatever you want with the money. But again, it's 2 years and it's no penalty. The penalty would be like, as we talked about. So like if the 2-year note rate goes up while you hold a 2-year note, then your bond is gonna go down. And so if you do this, what you want to do is you want to hold the bond to maturity. Because if you don't, and just like anything else, if the rate goes up, then your price is going to go down. Let's say you need that money. You had $10,000 in a 2-year note and the rates went up higher than expected because the Fed is being super aggressive. Well, now that $10,000 is going to be, see 1%. So the 10-year note is now going to be $9,800. So you're going to lose $200 automatically increase. And so now if you need the money, you're not going to be able to get 10,000. you're going to be selling the bond for 9,800. If the rates go down though, you already locked, so then your price goes up. So my point is, this is not something to where unless you plan on trading and you think the rates are going to go up, then, if you think the rates are going to go down, at some point in the future, you want to make a trade, you buy the 2-year with the expectation that rates are going to go down and the bond price goes up, then you sell it. That's a trade. The investment though is saying, hey, I'm going to put 10 in here and I'm going to collect this interest and hold it. And in the meantime, the rate that I'm getting is 92 basis points higher than I would even at the highest 2-year CD. So I'm getting an extra $92 per year just for picking a 2-year note above a 2-year CD. So, it's a trade-off. I mean, it's an easy, relatively easy setup. And like I said, if the interest rate goes up and you need the money, the bond price is going to go down by $200. So you're going to lose money. But the same is true with the CD rate. Like if you have $10,000 in a CD and you need to get the money out before it matures, then you're going to pay a penalty. And so, those are just some different ways and tools that you can use for generating cash flow on your deposits or cash equivalents while you figure out what you want to do with the money. Now, these instruments are these kind of things. I'm glad somebody asked that. These kind of tools are awesome for managing a holistic portfolio, right? So we talked about just the equity holdings, right? So like, let's say, because you're a whole person, we're all whole human beings, right? So the trading and investing is just one part of our lives, right? But we still have money that we need to pay the mortgage, money that we need to go on trips, money that we need to live the best life that we want, if we want to have a college fund for our kids and that whole kind of deal, right? So, these things are tools to, not only invest or hold excess cash in the meantime while you're trying to figure out your investment strategy, but they also serve as tools that can allow you to get something off of your money if you have a reserve fund, right? So, not to get too far into it, but like, let's say everybody should have, strive to have like 6 to 12 months of expenses saved up in a reserve fund. So that's like my go-to, but it's also rooted in principles from, personal financial management, stuff you can find from, anywhere on the internet, generally speaking, but it depends on, if you are the main earner in your household, let's say you're married, but you're the primary earner, you have kids, well, then your reserve is going to be higher than somebody that's single with no dependents. And so that drives how much you need to save. But there is a maximum. And this is where people sort of get things like out of whack. Like once you hit that target, you don't like thing. Right? There's a such thing as having too much cash and saving too much. And so if you have 6 to 12 months saved up in an account that's generating interest, let's say your number is, 30,000, right? And that covers you for 12 months if you aren't able to work or you don't have a job. And you don't own a home, right? So if you don't own a home, well, all the extra money, unless you're trying to save to buy a home, you should start thinking about investment strategies for that money because you don't need the excess cash. And then you're like, okay, well, if I want to invest, well, how long do I want to take to retire? Well, me and Jordan, we had this conversation. He was like, you need to accelerate your timeline. And I said, okay, well, accelerate my timeline. So I'm working on that. But outside of your retirement goals, let's say you want to retire in 10 years. Well, if you establish a reserve fund and then you got 30,000 in the bank, well, you don't need to keep saving. You could take some of that and invest toward shortening that retirement time frame. Or, if you've already done that, let's say, these hierarchy of things. So reserve fund, retirement, now you've done all that. Now you can say, okay, well, I got all that on autopilot. Well, I want to go to Aruba. I want to go to Egypt. I want to go somewhere, So you could do that. But, once you get to a certain point in the cash, because, I've seen it in the Discord, cash is a position, and you can have too much cash, it's a vehicle. It's not meant to be like hoarded. And so a lot of times we just focus so much on making money and doing all this kind of stuff that we like, oh, okay, well, now I have too much money. So that is a thing. Let's see, most of my portfolio is real estate, 3 single family, well, and a public employee pension, and a full. That's awesome. That is awesome. So somebody have portfolio, real estate, and so you route. So real estate works in a lot of ways as being the majority of a person's portfolio once you get in that route, just because of the asset size. Now, what happens is for most folks that are non-millionaires or billionaires, it makes up over 50% of the portfolio. Now, that's obviously significant concentration. And so I'm not going to get too far into portfolio management or asset allocation right now. But once you get to a certain point, you then cycle through the different sources of income. So you have, let's say in this case, this person has a real estate with single family home, 3 single family homes. And so their ROI is such that they are making more money than they are spending in cost. So their NOI, or net, the usual term referred to in real estate, then take that net operating income and then reinvest it in making those properties more and more passive. Because the first one usually, the second one is usually passive, but a little, still not all the way passive. And then as you grow the portfolio, then you start to scale. Then you can engage the management company, give up a little bit on the fee, but also increase the passive nature of your real estate investment. And obviously you can rent a duplex and live in one, and then use that income from the duplex or part of the unit to cover your living costs. And so from a scale perspective, it's just cycling that through and growing your portfolio that way. So assets as a asset, real estate as an asset class, equities as an asset class, bonds. So I will say equities, and then fixed income as an asset class, and then commodities, and which includes metals and all these different things. So all these different things are part of a sort of well-balanced portfolio. The public employee pension, that is excellent. I don't know too many people that have pensions these days. They started phasing those out a while ago. So that part is awesome. And so, reserve fund, if you're working and you're W-2 employee and you have a 401k, definitely get to the match, right? Like, people are like, oh, well, should I go all the way up? You could put 20,500 in a 401k, right? But if your employer is not matching past 6%, there's no benefit, right? The only benefit is the tax shelter. And so beyond 6%, you're just getting a tax shelter, where you can do that in an IRA on your own, and you have more investment options. And so that's the point at which it makes more sense to not max out your 401k unless you don't have any other options. And so then that's when other vehicles come into play, like, insurance vehicles, which again, that's a whole different discussion there, but yeah, I like that. Real estate is definitely a solid way, particularly as we start transitioning, because you go from a buy. It's almost like trading, right? So like when the market is booming from 2020 to 22, on that ramp up, it's a bull market in housing. So you could buy low, sell high. You could buy a place, you go in, rehab it, flip it. Or you could buy it, hold it for 6 months and flip it, blah, 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 blah. Or if you're prudent, you could buy super low interest rates and then you could hold it. And that's what a lot of these, so like, I don't know if you guys ever heard of Invitation Homes, but they're one of the number one publicly traded REITs. And they were started by Blackstone. So Blackstone started acquiring properties in 2010, 2012 timeframe at the bottom of the housing market. And so, I don't want to get too involved in what drove where we are now with the housing prices, but so Blackstone is buying up a whole bunch of property. Those of you that aren't familiar with Blackstone, it's a private equity company, asset management company, and they bought a bunch of single family homes. They founded the company, so it was like a wholly owned subsidiary. Then they spun it out and took it public, which now the company's name is Invitation Homes, and they own a basket full of single family homes. And Pulte Homes is a developer, publicly traded developer, which has a contract with Invitation Homes. And so Pulte is a developer similar to D.R. Horton and Lennar. Pulte has a contract with Invitation Homes for 2,700 units, in which every unit that's developed by, that's part of that 2,700 goes to Invitation Homes directly. And so when you think about the housing market, it's like, okay, well, why can't I buy a house? Or why am I priced out? Well, part of the reason isn't because what we talked about with M1 and all that stuff. So you're looking at where was this here? We were looking at this, right? So part of it is this, right? M2, but the other part is if Pulte Homes is taking advantage of all the people that have money, right? So they're an investor group, a real estate investment trust. They are developing these properties and they have a contract. So as soon as they are completed, they're getting sold to Invitation Homes, like automatically. So there's no way that you and I, individual Joe Blow, could go in, even if we had cash to pay, let's say $500 for a single family home, we're not gonna get it because they are selling direct. It's like a wholesaling, but just with houses. And so the developer, Pulte, is the manufacturer, and the wholesaler is Invitation Homes in this case. And they purchase the homes from them and then they rent them out. In this market, is selling options or buying large cap shares safer than buying options? Well, good question. So volatility took a dump today. I think volatility ended the day. Where did the VIX end today? So VIX ended 24, right? So now actually would be an okay time to buy options because they're cheaper, for the simple fact that this is all math in that case. So so option prices, you have an intrinsic value component and an extrinsic value component. The extrinsic value is time and volatility. And so kind of look here, we had 34, now we're back down to 24, right? So if you were to buy options now, volatility is likely to increase. And here's why I say that. We still have key pieces come out next week. We have earnings season starting all up again, and then we also have the Fed meeting, we have the quiet period before the meeting. So what that means is they're not going to be saying anything, doing anything. So all we have in terms of news flow is earnings, right? And some of these other economic releases. And so in the absence of that, there's going to be a little little volatility leading up to the meeting, right? So the meeting is on the 26th, 27th of the month. So it's going to increase from here just because of the uncertainty. So volatility is a uncertainty measure. And so what volatility literally is, it is the variation in price of the S&P index using options. And so as the variation of the increase, meaning the price of the S&P going up or down, that has shrunk over the last few days, but over the next coming weeks, it's going to expand. So the VIX is likely to expand. So if you are buying options, you can buy options now cheaper with the expectation that volatility will increase. So one of the things you could do is you could buy straddles if you're not sure on which direction things are going to go, but you know the volatility is going to go up. And then when these events start to happen, then you sell and you profit from the increase in volatility. It's just in time for earnings season, volatility will spike. Yes. So again, with volatility, it moves super quick though. You have to be aware of those things too. And if you're volatility trading, then you have to be aware of the too. And I think Avery, you mentioned this several times, and Moody too, but you know, you buy options when volatility is low, you sell options when volatility is high. And so if you wanted to sell options, you know, the time would have been like, oh, when everybody's, you know, sky's falling again, that's my favorite thing. Sky's falling, you know, sell options. And so one of the things I thought was really cool is on the show called The Industry that came out in 2020. It's like about investment banking and sales and trading and all that. It was like an awesome show. But one of the things they said, which is always true, is sell the VIX, buy the dip. So this is Monday, June 13th. The VIX is at 34%. If I sold the VIX, meaning if I sold a straddle, an at the money straddle, when the VIX is at 34% and brought it back today, I would have made a killing. If I also, and let's pull up this chart. If I also did this, let's see, that was, what is that? Actually, everybody likes TradingView, so I'll just use TradingView. I have the free subscription. At a certain point, I may go ahead and get the paid version. The reason is, I think Moody, this is when I first joined. I think it was Moody. He went through in one of his classes, he was going through some stuff and he had all these different watch lists. And you just like flip through the watch list, and then you have like a chart that just pops up and you can save all these charts. I'm like, oh my God, that would be like just so awesome, because you know, it's so many different ideas, so many different things that you think about throughout the course of a trading day or a trading week. And if you have like a watch list for different things, it's so much easier to look at it. So let's see. This is the 1 minute, and let's go out here. This is super busy, so my apologies. But let's look at what day that was. That was June 13th, 34 on the VIX. And see what happened there? That was that gap down day, right? Like Jordan has a profit calendar, right? It's certain sort of rules and things that if you do them systematically, or at least have an that they create opportunities for, I won't say risk-free, but close to it. You are aware of these different things. So here, you could buy here on this spike in the VIX on that day, right? So you sell the VIX, buy the dip. So you sell it at the money straddle, and then you simultaneously say that day you buy 370 SPY, right? Or 377, whatever that range was. So that day you're buying the SPY, and then you hold it. Let's see, what did Jordan do that day on the profit calendar to get from here to here? Anyway, so not a TradingView expert, but my point is, if you held from here to here, then you would have made, let's say you bought 374 and then sold at 388, right? That is so $14 in the SPY, and then your straddle would have made money here from 34% vol to 24%. And then you just do it all over again. And so now you do the opposite, right? So vol is low, so you buy volatility, and then you could sell up here. Again, and just reverse the trade. And you could do that all day. So, here we sold the VIX, bought the dip. Here we could sell the SPY and buy the VIX and reverse, and then do it all over again. Yeah. Or you could just increase your long position here. Now, there might be some more upside here. We might hit the top part of this channel and then come back down. But with VIX at 24%, you could buy some protection and puts that's cheaper than you could have bought them, earlier this week or last month. So Jordan, you got to show me that thing that you did, man. That was cool. I was paying attention. I just go back and look at the video to select the range. But yeah, so this is like the monthly. Back to the day. Clear some of this. So it's a little less annoying on the eyes. But yeah, from here to here, you make money, and then the other, obviously in the other direction. And so that's one way. And one reason why I wouldn't necessarily want to, like I said, it could go back channel here. I just took it off so we could all see it. I'm gonna take it out one more time. And then let's look at this. So this is the 9-day EMA, and this is the 21-day. And so we look here, obviously Jordan was talking about crosses. This is a slow, the faster one crosses slow, and if this continues to go above that, then, we could have a situation where we do continue toward up move. And if we have some strong volume, then it might be an opportunity to sell into that bear rally at a higher price while VIX is still coming off, and you can get a better price on your long option positions. if it goes through the top part of this channel, obviously then you have to switch what your thesis, hammer in and look at and revisit some of these fundamentals and say, if on the technicals, you go through that channel and then, the 9-day crosses the 21 EMA, and then we're still increasing on strong volume, then we're having momentum, potential continuation of an up move. And then you have to ask yourself, okay, well, is that a strong up move from a fundamental perspective? Are we still getting new housing starts? Is the yield curve starting to get back to upward sloping? Is the market pricing in the remainder of the Fed rate increases? If not, market and the Fed, the Fed continues with its increases and the bond market is still showing a flat yield curve, then maybe, what I'm looking at is a bear market rally. And so from a technical perspective, yeah, you're going to keep going. But then if you're buying into this and you start thinking about, okay, well, I'm going to buy here, and then it drops right after, then, well, before you even get here, examine those fundamentals, look at some of those indicators that we talked about, because that's, July 8th. So we still have the 11th. We have 10 days between now and then to potentially, if we count out the days, we have 10 days to get from today to the top part of this channel. So if something changes from a fundamental perspective and we're close to here, then you might want to say, okay, or examine or ask yourself, is this a bear market rally that we're in? Is this an opportunity for me to get out of some of the positions that I don't like? I've been holding some positions that have lost me about 20%. I'm down. Now we got this bear market rally. Maybe I can dump some of those and get into cash and break even. And then, obviously, if it bounces off of this and goes down, then you were right. Durable goods orders, they come in pretty weak. The yield curve stays flat, then that's confirmation that in addition to the technicals and this rejecting the top part of this trend, and we continue to go back down on higher volume, right, that your fundamentals and your technicals agree. I feel like Jordan, you was about to show me, man, how to go from here to here with that range.
So what are you trying to do?
So when you did the profit calendar, you took it was like a horizontal line, and we bought on this day and we sold on this day.
Oh yeah. Right above that smiley face on your left-hand side, use that tool. Right above that smiley face on the left-hand side.
This one right here?
And then I did the so you would do a short position. If this was a short, you do a short position or a long position. Yep.
Ooh.
And then you could drag it up.
Now, for me, everybody's different. Everybody's different. I'm just gonna say that I don't know what the if this was, let's see, on the 13th and I entered that day, I would say, well, we're probably gonna close that gap here. And this is where, for me, the learning part, sort of comes in terms of setting up different plays and things of that nature. But for me, I love this part of charting. But for that VIX play, just from a math perspective, I would say, okay, go down by so 24, 29%. And then what is that in dollar terms if I'm looking at a SPY move? So that's how I would have calculated the amount of return, which is almost equivalent to a 4% move up in SPY. So the challenge there though is with that type of trade, there's a drawdown in this case that, let's say that day, if I was doing it not knowing anything else in the future, it probably would have been something like that, in which it would have been 3% compared to 1%. Let me see if I can move some of this. So it won't let me delete all of this. I can unsave it, so I'll do that. But the illustration is, okay, well, if I were to do that, buy the VIX and sell the dip, what would be my expected payoff? And in this case, if and using this candle for that day, assuming I don't know anything else, and I'm buying here, this is assuming it's the middle of that candle that day. Everybody's selling, but I'm buying. And then I held until July 8th. The risk reward here is, if I'm looking at this right, it would be 3.27% gain versus 1.08% loss. And so that's not bad, right? I mean, for you to just say, I'm gonna sell, because it's a hedge position. And so when you do both at the same time, you're buying the SPY and then you're selling the straddle. And so you're, in essence, it's a volatility direction neutral trade in which you make money both ways, because your short straddle, your delta is going to be negative because you're short volatility, but your long SPY position, if you don't do an exact delta hedge, you'll be slightly short, but you'll make money on the long position on the SPY, and you'll make money on the short position on the straddle. And so that's what, $1,011 on the SPY trade, which is the difference between the 1761 and the 750. That's expected rate of return now. Like you could, let's say if you didn't lose this at all and you weren't fearful of the drop. So how I got to that number, I subtracted the 1761, the 750 from the 1761 to get that. Excuse me. To get to 1,011. But that's expected value. So like the likelihood of it going up versus the likelihood of it going down. And I just did like a 50-50 probability, but you could, in all intents and purposes, not have any drawdown and make the whole 1761 on the long end of the trade for the SPY and make your money on the long, the short straddle. So, yeah. Any questions? Any questions? I think I went through all the ones in the chat. I need to get the paid version so it doesn't pop up on me again. The ads keep popping up. They're like, oh, you don't have the paid version. So yeah, any thoughts? Any thoughts? Whatever you can think of, let me know. All right. If y'all don't have any additional questions, I think this is recorded. And so think of anything that's not on the video when you go back and look at it, definitely let me know.